quick minute and a half on kind of who they are, where they're from, what your investment perspective is.
Absolutely. Pleasure to be here. My name is. I lead healthcare investing strategy for our single family office. Our family office called based in Southern California. We also have an office in New York. We invest primarily across three strategies: real estate, public equities, and what we call venture and growth. Within venture and growth, we focus on two sectors, healthcare and fintech. And I lead the healthcare strategy for us. Manage about $2.9 billion in AUM in invested assets today. Mostly invest directly into companies, not so much managers.
Great, thank you. Should be on.
Good morning, or good afternoon, I should say. My name is. Pleasure to be here. My second time to attend this conference. I'm from Seattle. I work at doing debt and structured finance. So our team financed about $3 billion for our institutional commercial real estate investors nationwide in the last few years. So outside CBRE, I'm also in the process of setting up a family office based in Seattle. So our future strategy would be I would say 60 to 70% focused on commercial real estate because that's what I'm very, very familiar with. And the rest of the allocation would be in venture capital or private equity. Healthcare would be a focus in AI technologies.
Great, thank you.
Good afternoon, my name is I'm the founder and CEO. We have our investment office in Greenwich, California. Office in Scottsdale, Arizona, and our major operating companies is in Salinas, California, which is referred to as the salad bowl of the world. See the hesitation there? You like salad? Yeah. Salad bowl of the world. 80% of all of the salad that you eat comes from Salinas, California. And we have 13 different companies under our umbrella at the moment.
Awesome. Thank you for being here.
Hi, my name is I'm the founder of our firm focuses on sourcing and conducting due diligence on differentiated high quality alternative investment managers and GP-led co-invest predominantly to family offices. Prior to EME, I spent 20 years at a multi-billion-dollar family office as a director. During my tenure there, I probably allocated to in excess of 200 alternative investment managers. My expertise is really a generalist. I've looked at all strategies, but a little bit more of a focus towards the liquid side, hedge funds, private credit. Done a lot of allocating over my years and look forward to sharing my thoughts.
Great, thank you.
Hi, I am a co-founder of Management. We are a national real estate investment trust specializing in private credit. We have one strategy. It's simply just real estate private credit.
Great, thank you for being here. So a few of you mentioned an interest in healthcare or venture capital or maybe hedge funds, et cetera. But do a couple of you want to share something that's super specific, like some really small niche within healthcare or venture capital or alternatives that maybe someone here in the room is exactly what you're looking for in that small niche?
Sure, I can get us started. Specifically doing a lot of work right now on all things healthcare and biological data. So if you have a company that has some access to a net new data set or has some new way of aggregating, cleaning up, standardizing the messy world of healthcare data, come talk to me.
Great, thank you. Anyone else want to add something really specific?
I want to add the focus that we have is on food waste, and we're investing in ag infrastructure. And what's that mean? Cold storage facilities and all of the supply chain to make sure that all fresh produce maintains its temperature from field to table.
Great, thank you. You want to add something?
Yeah, I can add a few. So within the commercial real estate field, our strategy right now is to focus on the existing assets, multifamily sector, because there are a lot of opportunities you can buy at discount without doing development. So in the healthcare industry, I've been looking at a few companies recently. One is like retina imaging technology enhanced by AI, and also in the food sector, allergens for baby. So
Okay,
it's just
great.
a few examples.
Sure. So you're really connected in the real estate space where we are with interest rates and inflation and real estate valuations. Do you lose sleep being in the real estate space? I know you guys manage over $1 billion, so just kind of curious in your perspective.
Yeah, it's a good question. I don't lose sleep. I make other people lose sleep. And I say that because as a lender, there's a reason why I'm in private credit. It's because I don't want to take the risk that equity players take. And we're in the debt space for a very specific reason. I always want to be where I'm in control of the entire capital stack. And being in control of the capital stack, that's what allows me to sleep very peacefully at night.
Right. I have a follow-up question on that. I know you've spent over 30 years building, backed by Oak Tree Capital. Howard Marks is a billionaire, well-known investor, head of Oak Tree. And over 3 decades, we talk about investment structures here in the club and going deep on investment structures. And when you spoke at our mastermind, it struck me that you've spent over 3 decades, probably 1,000+ transactions, negotiating, customizing your own proprietary or preference for structures, and it's come up a few times at the event. Can you comment on the importance of that? Because when I hear Warren Buffett say hey, over 50 years, I'm competing against CEOs and conglomerates, they trade out every 4 to 10 years. No one else does this for 50 years. And that must give you such a sharp edge on structures, being an attorney as your background. Can you comment a little bit on that?
Yeah, happy to. Like you said, it's definitely an evolution of over 30 years. When I first started in the real estate business, I never in a million years imagined I'd be running a multi-billion-dollar fund. And how did I get there? I started off just doing real estate deals in the Bronx. And I would not, for the first 10 to 15 years, and I kid you not, I would not do a deal outside of the Bronx. That's what I knew, that's where I was comfortable, and that was it. And the way I did those deals was I would use my own capital, and then I would participate out the rest of the stack, so to speak, to get that deal fully funded. So just to keep the numbers easy, if I was doing a $100,000 deal, maybe I'll come up with $20,000 and then would participate another $80,000 to get that deal done. And when I started, that was the amount of deal flow that I was doing. It was maybe $100,000 to $250,000 deals. So to Richard's point, that lasted a good 10 to 15 years until I started growing and said, all right, maybe I'll do a deal in Brooklyn. And I know a lot of you are not from New York, but for those of you who are, doing a deal from Bronx to Brooklyn, you may as well be in a different country. I mean, that's how different values are, court system, borrowers, very different borough to borough to borough. So it took that amount of time to really figure out how a lot of the boroughs work. But just to get back to the structure, I realized that, all right, participating on each specific deal, and even if I was using some financial engineering and leveraging on the back end of a deal, it really wasn't conducive to creating any enterprise value, to creating any sort of fund structure where I could go out and actually get a leverage facility across my entire fund, which eventually led me to then go and get a fund structure. And I did the typical fund structure, set it up as an LLC with a pref return and the waterfalls and an 80-20, like all just what you see in a typical fund structure. Fast forward, evolved one more time because we've noticed that a lot of our investors wanted also, because we're a debt fund, it wasn't that tax advantageous. So how do we make it more tax advantageous? So we evolved one more time where we restructured the fund to become a REIT, a real estate investment trust. And if that wasn't enough, just in the whole basis of evolution, I'm sorry if I'm going
No worries, go for it.
here. But in the basis of evolution, then we also realized that, all right, even a REIT is not that tax advantageous for all of our offshore foreign investors. So then we had to go to Luxembourg and Cayman Islands and start setting up blockers and feeder funds just to make it more tax advantageous for everyone. And it literally took 30 years to come up with the proper structure where we're now a national REIT with a Cayman Island blocker fund, and it's very tax advantageous to everyone involved.
Awesome. Appreciate you sharing that. Thank you. If somebody is trying to approach $1 billion plus family office, whether it's single family office or multifamily office, and a lot of people try to do so, What is something you could suggest to them that might cut the time down in half of you really understanding what they're trying to communicate, or really to clearly stand out from all the other stuff coming into your inbox? How do they get the attention of someone like yourselves that are representing billion-dollar-plus families?
Yeah, I think for us, it's actually easier than most because we're quite public about it. I post pretty actively and I speak at things and I talk about what themes I'm interested in. So if you've done, let's say, even an hour of research looking me up, then you kind of know what I'm interested in investing in.
Right.
And if you send me something that's completely out of that wheelhouse, then obviously you haven't done any research, right? So for us, it's actually easier. A lot of the family offices are not that public about it, so it might be a little bit more difficult. But I think just a strong first email with like a blurb about exactly what you're doing. I cannot tell you how many times I'm on a pitch meeting and 45 minutes into the meeting, I still don't know what this company does. So that's the dead on arrival, right? So just very clear blurb about exactly what the company is doing and attach your deck in a PDF, please, because the more number of times we have to go back and forth to ask you for preliminary information just creates friction. You lose a lot of time. People miss emails. Everybody is busy. So just give them what they need to see to make that initial pass of whether this is in my wheelhouse and I want to take a meeting or not.
Awesome. Yeah, you're so evolved as a single family office compared to others in getting the deals you actually want, because there's someone on your team open to speaking publicly, commenting publicly on social media what you're wanting, being clear that you're interested in healthcare data, healthcare in general. And that's miles beyond most family offices. They feel like if they do anything public, then people are going to find out the family name, but they could create a brand around the family office and hire professionals. And they don't do those things. And some families, I try to tell them, if you want to get better deal flow, especially in a niche, go out there and say you're focused on that niche. And they'll say, well, we don't only do that niche. I'm like, yeah, I know that. But you're never going to see deals first if you don't have any focus, right?
Yeah, I think this is generally true in life. Most people operate under the fear of missing out. If I scope it too narrowly, I miss out on all the other stuff. But in my experience, life works actually the other way around. When you set an intention and you are committed to that intention and you're vocal about that intention, you attract people and opportunities that further that intention.
Right, yeah, for sure, awesome. And by the way, if any questions come up, my team can alert me and we'll bring a microphone over to you. What about yourself and your experience? You've allocated over 200 different investment managers, some of which might be here in the room or offering a very similar strategy. So what would you suggest for getting the attention of billion-dollar-plus family offices?
A connection to the person you're reaching out obviously is a big one. You know, LinkedIn would be a great way to see if you share anyone in common and say, hey, I know this person. Usually if you get a call, you're not going to pick up the phone and you probably won't even call them back, just because you just get so many inflow calls. It's just impossible to keep up. You know, it's always great to reach out to that family and say, what do you focus on? And you know, we'll say, hey, our average ticket's 10 million, and we don't want to be more than 10% of a fund, so you got to be at least 100 million. You got to have a 3-year track record, and we don't do anything with liquidity worse than quarterly. So immediately, you know what they are, and if you can fit. And then if you do an email, I think it was already kind of really nailed, but you just want to do 3 points. One is what do you do, your edge, and what makes you different, and then 2 is your performance, and that's, I don't want to say everything because, but it's pretty close. Have you performed well, and ideally over different markets? And then the last one would just be your experience. And then you attach your one-pager, you attach your presentation, but very short email, straight to the point, and that's at least going to get a quick read, and most likely a response. That is your best probability for a response.
Awesome. So if anyone missed that, say very concisely what you do, what is unique about it, what's the edge, and what your performance is. And I'm sure if you could say that in 3 bullet points or 2 sentences to cut to the chase, and maybe suggested have a drop links link or some sort of PDF to be able to open up materials real quick. If that email is super short, that'd probably be better than 90% of emails that get sent to investors, I would guess, based on what you just said. Were you going to add anything to that before I move on? No? Okay.
No, that's perfect.
You want to say something?
Yeah, I want to add a little bit. I found that like one pager sometimes is helpful. I receive like 49 pages deck. I dive very deep into the terminologies, the biological terminologies. It can be very hard to digest, but if you can summarize your thing in one page, be concise. What's a problem that you're toggling, and then what's your solution? What differentiate yourself, and how large is the market? I think that would be very helpful.
Right, sure, yeah. I know one of our investors took like a 50-page pitch deck and just put it in ChatGPT and said, summarize this thing for me in like 7 bullet points, because I don't have time to look through this,
It has become so much easier now with that, and I think if you can't even do that, then that says a lot. I have a talk on YouTube about how to create your pitch deck. And I talk about it shouldn't be more than 10 to 15 slides. So for someone who's working on it, if it's helpful. More intended for companies, not for funds. But
awesome. Yeah, we always say 12 to 19 slides, so super similar compared to the average 44-page deck you see there. We haven't heard from you enough. So you own 13 companies in this area. Can you talk about how maybe the niche focus or what strategy led to you having successful negotiations to buy those companies, and what led you to be successful in raising the capital needed to acquire them?
Yes. Why did I buy them? I'm still trying to answer that question. A lot of these companies that we looked at are typically fourth generation family companies. And what we find is in our space, especially in the ag space and the Salinas, California area, it's all family-owned businesses, right? And what we started to identify is the families, a lot of them did not forget who took the toy away in the sandbox in the 3rd grade. So they had a lot of ego. So the companies started to take distributions, take all the money out of the company. So we recognized we could come in, offer a fair valuation, do the blocking and tackling. I think we all know what we mean by that. Do the hard work, and started adding value, start having consistent returns in EBITDA. Get your management team in place, and then you can go out and start telling your story. What problem are you looking to solve? How are you going to solve it? And don't take all day to tell me how you're going to get there.
Right.
So just be straight, be concise, as I'm not being right at the moment. Be very, very, very straight. So then you've got to put real accountability in place to hold all of your management team accountable to the matrix, to the overused word, the KPIs. And you've got to continue to educate. We are a strong company in education. 97% of our employees are Hispanic. We offer every employee an opportunity. If they do not have a high school education, we will pay for it. If you want to go to college, we will pay for it. Wow. People are getting very concerned about the overused word AI, and I've been in this business over 53 years, and my AI was a slide rule, and I thought I was really high technology, which is an HP calculator. So we have got to remove the fear of the employees that they're going to lose their job. So hopefully that gives some insight.
Thank you. Appreciate that. And you talked about acquiring multifamily properties at a discount. Is there any niche area you're focused on, like student housing multifamily or workforce or anything like that?
Conventional multifamily. So for example, we were raising equity, like $400 million equity for an institutional client based in Seattle. So they already have $3 billion assets across the US. So they have been purely focused on multifamily assets. They own 10,000 units. So their most recent transaction was in Arizona, Scottsdale, $117 million purchase price. When the seller bought it 3 years ago, they bought it for $143 million. So it's a huge discount. And it was brand new. It was built into 2021. The reason for the discount was the seller put a 3-year bridge financing back in 2021. So it's matured this May. So with Deutsche Bank, 84 million balance, right? So we financed the debt for 64 million fixed rate with Freddie Mac. So there's a delta of 20 million. So you either sell or you need to cash in, refinance, come up with the 20 million delta. So that's why there are a lot of opportunities come from this situation.
Yeah, it makes sense. I read a report that in 2022, 5 times as much capital was raised for real estate than 2024 so far. So if anyone's having trouble raising some capital, there's others out there as well. The other thing that makes it more challenging, even though if you're in the business, you have to plant seeds and gain new relationships right now for later, is just that some families are used to seeing, and some investors are used to seeing, like a rescue capital deal coming in to recapitalize a platform or a distressed asset or hard money lending, and the returns are pretty good. And like John, maybe you're sleeping at night because you're on the debt side of the balance sheet. When you have a traditional deal, sometimes it can be a little bit harder right now at this moment in time because of the families are used to seeing these kind of rescue capital type deals come by, has been my experience. Do you have any questions out there in the audience for any of our panelists that you're curious about and like to get their opinion on? We had a couple questions planned for the panel, but I want to make sure and go down the line to provide like $1 million insight that you'd love to share at the room, or answers to one of the questions we didn't get to. For example, is there something out of favor right now that you think is coming back soon, or something so unpopular that nobody really talks about it, and that might mean it's a good time to go in? Actually, like Howard Marks from Oaktree Capital, he's famous for saying that like when something is unpopular and other people think you're not smart to go into it is when you can get a good deal. And when they think that it's pure toxic, then sometimes it's the best deal of a generation or of a decade, because it's so discounted and unpopular right now. So we could answer one of those questions, or just provide your number one insight you want to leave the room with today that you think could, at least to someone in the room, add $100,000 or $1 million of value to. You usually have an answer for just about everything. You want to start us out and work your way down the line?
Yeah, I'm happy to. I just kind of piggybacking off of what you started with respect to where we see opportunity. And again, I'm a real estate investment trust. I'm a fund manager for a REIT, so it's obviously very industry specific. And I don't know how many of you out there are in the real estate world, but what we're seeing right now is a maturity wall where a lot of the debt that real estate owners had are now entering maturity. And this is creating a tremendous opportunity, right? I mean, again, not to give you a real estate lesson, but there's 2 ways to make money in real estate. It's either net operating income or your market discount rate. And they're both directly linked to interest rates. So think about it. Your debt remains exactly the same right now. Your rents are the same. Your operating expenses are the same. But as interest rates rise, your cap rates also rise, which devalue your real estate. So now you have a maturity wall. You're going to refinance. You are lucky if you're getting 50% of what your debt is today. That is going to create, and we're seeing it in the industry. It's creating tremendous opportunities for real estate investors, because now they're able to go in and either infuse equity, because the only way to refinance without getting a new mortgage is to just pay down the loan, obviously, or they're just selling the properties outright. So we see a lot of opportunity there.
Right. I think it's really important that one impact of what you just said is that right now, the last 9 months, more than the last 7 years combined, we've seen investment managers stop distributions, lower distributions, have to recap projects. In some cases, investors get wiped out on projects. And some investors, rightfully so, get upset when their money stops producing income for them that they relied upon, or get upset when some money is lost or there's a reduction in value. But the whole industry is being impacted by this, unless you had long-term fixed, 2.9% debt, then that was smart of you to lock that in. But just know that even some of the most honest, hardworking, high-integrity managers out there have to do some of these things that John was just talking about. It doesn't mean that they misled you on purpose, et cetera. It's one of the risks, and it's one of the natural fluctuations in the real estate market. It's what happens, right? So any last comments you'd like to share?
Yeah, I mean, continuing on the theme of maybe what's out of favor and on the real estate sector, I don't think it's quite 08, 09 opportunity, but within the distressed CMBS space, these bonds have traded off pretty substantially. And there's people out there with specific expertise to really go after that fulcrum security and cram down the equity and the junior debt. And these bonds come along with special servicing rights. So you can go to the special servicers and get an extension on the old debt that was issued 3-4 years ago at 3%. So I know that a lot of these stuff has been thrown out baby with the bathwater, but there is single name CMBS where the underlying asset of the CMBS is just one particular property. So you can really do your digging on that, and you're not just looking at a portfolio of 20 different properties within the securitization. Just another big area that I'm a big believer in is just finding niche, uncorrelated managers, and just good old-fashioned portfolio, construction. You're going to have some things that sell off. You want to have other parts of the portfolio that aren't correlated. So things like appraisal rights, mitigation finance, California carbon credits. That's a niche beta. Factoring. Just being able to kind of diversify your book portfolio and uncorrelated investments. I think just creates a more powerful and high quality return.
Great, awesome. Yeah, I think a lot of investors who see a lot of deal flow and like you have selected a lot of allocations, after a while, if you don't do a good job of what you said and what you said earlier about your unique edge, everything kind of starts to look the same. Like a lot of people that email you, it's like I feel like I've read this email like 900 times before. So it's so critical to appeal to people like yourselves that see a lot of deal flow to be super clear on that unique edge, right? Awesome. Any last comments you'd like to share with the room? Any big insights?
In our industry in Salinas, I think I heard a stat earlier with one of the other moderators about how many people were turning 65 years of age, 10,000 a day. What we're seeing in our industry, all family-owned businesses, that is occurring. They're not prepared for an estate. As surprising as that may be, they're not prepared to pass on their companies. So then you go to the real estate side from the cold storage industrial. Average age in Salinas is 45 years of age. There has been no upgrades in technology. The debt's coming due, as you said. So we see opportunities there to move in from an educational standpoint. Say, we can help solve your problem by working with your debt. We can help solve your problem by doing some capital investment and bringing some management expertise to our particular area that we know well.
Right. Makes a lot of sense. To your point on the debt side and it being harder to find, the last couple of years we acquired about $5 million in real estate. We just did all seller financing, and our LTV is like 23%. And all the seller financing runs off after 3 to 5 years. And we got some of those deals done at the height of the real estate market. Now people are much more negotiable on getting seller financing done because they may need that liquidity for another asset. And it's the only way they can get the deal done sometimes. So I appreciate you bringing that up. It's a time of opportunities, as long as, like Warren Buffett says, when there's a flood, you want to be selling life preservers, not begging somebody for one, because banks don't want to lend money when people need it the most. They want to lend money to the people who are so well positioned, they barely even need the money. And Warren says that himself. He says he doesn't use high debt, very low debt, and then maybe once every 10, 20, 30 years, he'll put on a moderate amount of debt. But that's like an emergency action. It's like a cash reserve. In the last comments, insights you'd like to share with the room?
Maybe two aspects. One is stay focused. Using the same example I just mentioned earlier, client has 3 decades experience, focus on the same area. That's why when opportunity present, they can seize the opportunity. And they did that successfully in OA. For the 5 years between OA and 13, they achieved a 53% IRR. That's why they're so confident to use the same strategy right now, even though lower expectation, maybe 20% IRR, but still similar pattern, right? So you mentioned the stress in commercial real estate. Of course, there's stress, but like I mentioned, the crisis for some could be opportunity for the others. And right. That's number one. And number two, I would say is lifelong learning. That's to develop yourself. Like I myself am learning, doing my MBA program at Wharton University, Pennsylvania. So just to further broaden my view.
Sure, yeah, it makes a lot of sense. One challenge of running this event with 100 plus people on stage is that any one of these people has enough experience to do a 2-hour workshop over a breakfast or a full day workshop of everything they've learned. and they're only up here for like a few minutes, but the point is just for you to know who they are, where they're from, what they're focused on, and then we can network with them during lunch and cocktails here in a couple minutes. And then the favorite speakers from the audience we'll have back for some of our investor masterminds, and do like a little bit longer fireside chat to dig deeper into how it sources deals or something of that nature. But do you want to finish us up with the last insight for the audience?
Yeah, sure. I would say, to build off what Regina said, opportunity hides in plain sight. If you don't like waiting for a cab, build an Uber. If you had to drive 2 miles to go pick a piece of gum, build an Amazon. You had to go wait in the ER for 3 hours with a broken hand, build a healthcare company, and then come pitch it to me. Yeah, opportunity is everywhere. Just think about your life, your experiences, and reflect on them to derive insights that can change and meaningfully improve those experiences, not only for you, but also for others around you, and then have the fortitude to go build something.
Awesome. Appreciate that. And thank you. Thank you to everyone here on the panel for sharing their thoughts and ideas.
Join the Family Office Club by visiting familyoffices.com. We look forward to seeing you at our next live event.